Canadian banks are setting aside billions of dollars in loan loss provisions, and this has many believing that they are doing so, expecting there to be a mortgage renewal cliff. But the reality is, this probably isn't what the banks are doing, and it probably isn't why they are setting aside so much money for loan loss provisions. And in this video, I'm going to discuss what is happening with those loan loss provisions, the more likely reasons why they're actually setting them aside, and what the Canadian mortgage landscape looks like from an arrears and default perspective, because it is significantly different than what media companies like the CBC, for example, would have you believe. But before I get into it, my name is Nolan Matthias, and if you want the latest Canadian real estate and financial news, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. And don't forget, you can still get my book, Mortgage Secrets, for free. Just pay the shipping and handling by going to mortgagesecrets.ca. Okay, so let's get into it. Let's discuss Canadian loan loss provisions and what exactly is going on here. So I want to start by taking a look at this article from the Financial Times. Canada's big banks logged 13-fold rise in loan loss provisions. Well, now, what you'll note is that this article is from 2023. It goes back almost a year. And it actually has a better grasp of the reality of what is happening with these loan loss provisions. And there's two major reasons why Canadian banks are setting aside so much money. And they don't really have to do with mortgages or mortgage renewals. Yes, that's a small part of it, but it is not the big part of it. And I'll get to what those two reasons are in a second here. But let's start by taking a look at what's actually happening in the Canadian mortgage market. And let's take a look at what is going on from an arrears perspective and whether or not there's something to worry about with respect to a mortgage renewal cliff. So I want to start by pulling up this article from the Financial Post. RBC beats expectations even as loan loss provisions surge by more than 50%. Now, Canadian banks have now put aside over $300 billion for loan loss provisions. And the banks are still beating their expectations, but they're putting aside more money. The question is why? And the question is, really, is it because of a mortgage renewal cliff? And the reality is, no, probably not. But that doesn't mean that there aren't things happening in the Canadian mortgage market that are of concern. For example, in this article from Canadian Mortgage Trends, you can see that EQB has seen impaired loans double in Q2, but expects improvements ahead. Now, EQB, Equitable Bank, as it was formerly called, is a bank that specializes in alternative lending. So they do things like reverse mortgages and things like, I don't want to call them subprime loans, but they aren't bank loans. They're B or C type loans. And their book of business is typically more risky than what a bank's would be or a company like First National or MCAP's would be. They deal more in the fringes of the mortgage market. So it's not surprising that they're the first to see, I should say, loan losses and arrears start to increase. And when you take a look at the data from this article, what it tells you is that EQB saw gross impaired loans double 0.98%. That's up from 0.49% a year earlier, but down 0.99% in Q1. Now, the good news here is that almost 30% of the impaireds we are reporting in this book have actually cleared up since the first quarter. Now, that being said, when you think about this, and EQB is a big company, they only had 200 of their loans that were in arrears. So in the grand scheme of things, yes, there was double the amount of arrears, and this is typically more than 90 days old, or more than 90 days late, but in the grand scheme of things, it is not a very big number compared to the overall size of their book. So the question is, what does this all really mean, and why are EQB's numbers so high, and what's actually going on with mortgage arrears in the Canadian market? And there's this classification of companies, it's called mortgage investment entities. These are companies that do second loans and more risky lending. Now, EQB doesn't fall into this category, but their book of business is more similar to this category than it would be to normal banks. And what you can see is mortgage investment entities tend to have higher than normal rates of arrears. You can see that they're up around 1%, which is about where EQB is. But when you look at the rest of the banks, when you look at credit unions, when you look at other non-bank lenders, this includes companies like First National and MCAP, which we love because they have better products than the B lenders, which are the banks. Well, the numbers here are still very low from an arrears perspective. They're still well under 0.2% of all mortgages. So 2 mortgages out of every 1,000 in Canada are in arrears typically right now. And as we move a little bit further on here, there is really good reason for that. And the reason that the mortgage arrears numbers are still low, but are increasing is quite simply to do with unemployment. In fact, unemployment is the single biggest factor when it comes to people missing mortgage payments. And if you take a look at this chart, it clearly shows unemployment, which is the black line. And then the other line underneath it, the graph underneath it, the shaded gray area, is the Canadian Bankers Association's arrears rate. And as you can see, this number tends to fluctuate fairly evenly with what's going on from an unemployment perspective. And right now, unemployment has ticked up about 1%, so we would expect that arrears are going to go up as well. Now, the big thing here is that if unemployment remains fairly flat, then arrears shouldn't increase very much because the unemployment actually has a bigger effect on arrears than interest rates do. And all that being said, you can see that the arrears rate in Canada is still relatively low compared to pretty much every time going back to the 1990s. In fact, the only time it's really been lower than it is right now was during the middle of the pandemic when everyone was making money, there was less worries, and there was higher savings rates because people were not YOLOing their money on pretty much everything that they could possibly do before the pandemic. So yes, we are finding ourselves right now in a situation where arrears are increasing. That's largely due to higher unemployment and depleted savings. And that is the main thing here. This is the thing that you need to understand, is that these numbers are still quite low, even as people have been renewing into higher mortgage rates. Now, that takes us into our next graph, which is the mortgage arrears in Canada relative to other countries. And what you can see here is that our arrears rates are way lower than they are in other countries, especially the UK and the United States. Now, the United States has this cool thing. You can get a mortgage that's locked in for 30 years. And because of that, you would think that they wouldn't have as many people missing payments. However, that's not the case. And the reason it's not the case is because most of the time, arrears comes down to unemployment. Even in a country where interest rates remain flat for a very, very long period of time, there is no mortgage renewal risk, you see higher arrears rates. And again, that is clearly because missing a mortgage payment has more to do with not having a job than it does with having to renew at a higher interest rate. And there's some protections in Canada around having to renew at higher interest rates, including the stress test, which made pretty much everybody qualify for at least 5.5% over the last several years for a mortgage. And guess what? People who are renewing right now are finding themselves in a scenario where they're renewing at less than 5.5%. So while money has gotten tighter, the stress test has allowed most people who have to renew into a new mortgage to be able to afford it while simply having to adjust their lifestyle. And when it comes to missing mortgage payments, people would rather adjust their lifestyle than miss a mortgage payment and risk losing the home that they put $20,000, $100,000, or $200,000 into in order to be able to buy it. Now, CMHC recently put out a report, and it included this really great table that was the indicators of financial stress amongst mortgage consumers. And as you can see, there are two categories, savings rates and mortgage consumer confidence, that are in the early stages of creating financial pressure for Canadians. Then there are two that are in the intermediate stages, which are financial and credit behavior changes. I'll talk about that in a second. And consumer debt product arrears, which exclude mortgages and HELOCs, which again, I'll talk about in a second. But when it comes to mortgage arrears, we're starting to see this as being in the advanced stage of financial pressure, even though only 0.19% of people are actually missing their mortgage payments. Now, this is up 5 basis points, or about 25% from a year ago, but nonetheless, the arrears rates are still historically low. And when it comes to being in arrears, it turns out that if you have mortgage insurance, if you bought with less than 20% down, you're more likely to be in arrears than if you have an uninsured mortgage or a mortgage where you put more than 20% down, or maybe you just had it for a long time and you don't have insurance on it anymore. And this largely comes down to people's capacity to save, and the people who have had the ability to save more money and have more assets tend to be less likely to be late on their mortgage payments. Now, I want to pull up this chart as well, because this is the estimated percentage of mortgage holders at high risk of not being able to pay their monthly mortgage payments. And there's a few scenarios here, but what I'm going to do is I'm going to ignore the baseline, which assumes the same interest rate at renewal and the same level of unemployment. And I want to take a look at the dotted blue line, the red line, and the gray line, because these are 3 scenarios that basically look at what would happen if interest rates increased. Now, in the scenario where you see 15% higher unemployment, you start to see the arrears rates come up pretty significantly. When you look at the difference between the two scenarios that have 6.5% interest rates at renewal and these same levels of unemployment with one tweak, which is the gray line is a 40-year amortization instead of a 25 or 30-year amortization, what you can see is that the numbers are virtually identical, which supports the point that unemployment has a significantly greater impact on risk than higher interest rates do. Now, that's not to say that a 1% higher interest rate or a 3% higher interest rate won't be painful, but for the most part, it is the unemployment that creates the greatest amount of risk, especially when you consider that the 6.5% interest rate that they're using to calculate these numbers is significantly higher than what people are actually renewing at right now. And by all accounts, what they will actually have to renew at in the next 2 years, especially when you consider David Dodge's prediction, the former Bank of Canada governor, who suggests that interest rates are going to come down by another 1.75% by the end of 2026. Now, that leads us to some data on the actual stressors in the Canadian economy and how bad it actually is. And this is a chart that compares the Equifax risk score to the Bankruptcy Navigator Index. And here's what you need to understand about this chart. I know there's a lot of numbers on it, but there's two columns we want to pay attention to. It's the high-low column and the low-low column. So the high-low column indicates that people still have a high credit score, but they have a low Bankruptcy Navigator Index, which means that they are more likely to declare bankruptcy in the next 3 to 6 months. And then the second column is the people who have a low credit score and a low Bankruptcy Navigator Index, and these are the people who are really in trouble. Now, there's an argument to be made that if they have a high Equifax risk score and a low Bankruptcy Navigator Index, they've probably just been borrowing to pay their loans, which is essentially like running your own personal credit card Ponzi scheme. You borrow from one lender to pay the other lender. And when you look at the numbers, both from the high-low perspective and the low-low perspective, relative to Q2 of 2022, when both of these numbers were at their lowest, which meant there were the least amount of people in these categories, what you can see is that the number of people who have gone from being in this category has gone up by about 0.35%. So from 2.75% in Q2 of 2022 to 3.11% in Q4 of 2023. And then if we look at the low-low, again, Q2 of 2022 to Q4 of 2023, we see about a 1% difference in those numbers. So there's about 1.35% of Canadians who are at greater risk of declaring bankruptcy, and that is usually when you start to see people default on their mortgages as well. So what this means is we've got about 1.35% of the population that is at greater risk, which lines up pretty closely to the unemployment numbers, which are up about 1% over the last year. Now, here's the thing. There are 3 things that put you at significantly higher risk of defaulting on your mortgage. They are, believe it or not, student loans, credit card loans, and auto loans. And if you have any of these 3 types of credit facilities, you are at higher risk of missing your mortgage payments. So the reality here is if you have a mortgage, it's starting to feel tight, and you've got auto loans, credit card loans, and student loans, the best thing you can do is start to pay those off as fast as possible. And the simplest way to do that for most people, if they have an auto loan, is to liquidate the car, get rid of it, and get rid of that loan. That's just an aside. But all of that being said, with the arrears rate at 0.19%, rising gradually, unemployment rising gradually, is there really a significant risk of a mortgage renewal cliff? And is that why Canadian banks are setting aside so much money when it comes to their loan loss provisions? And the answer is no. The mortgage market in Canada, the types of loans that have been given out for housing are still very stable. The stress test helped with that significantly. And there's actually 2 factors that are leading the banks to put away so much more money in loan loss provisions. The first is the expansion of Canadian banks into the US and the exposure to the US lending market. Obviously, we've seen this with articles like TD's US expansion plans called into question amid regulatory troubles. I mean, there's so much more risk for Canadian banks as they start to go into the US market. So a lot of the loan loss provisions have to do with those forays into the US market. But here's the bigger one. And here's the real reason why Canadian banks bring so much money away for loan loss provisions. And that has to do with delinquency rates for mortgages backed by commercial, not residential properties. The commercial mortgage market is in one of the worst places it has been in decades. And we are now seeing arrears rates on commercial mortgages up around 6%. So compare that to residential mortgages, 0.19%. We're seeing 6% arrears on commercial mortgages. The loan loss provisions are for the commercial mortgages, not the residential mortgages. So while there are many people suggesting, including, like I said, CBC, that the loan loss provisions have to do with the upcoming mortgage renewal cliff, the mortgage renewal cliff, especially as rates are starting to come down, is becoming less and less of an issue. The commercial mortgages are becoming more and more of an issue. So when it comes to having a mortgage, when it comes to renewing your mortgage, there isn't as much to be concerned about as many people would have you believe, because you've already qualified more than likely at 5.5% higher, which means you can more than likely afford your mortgage, especially if your income has increased. Now, if you lose your job, that's a different conversation, but a mortgage renewal is not a reason for you to be concerned about losing your home. Now, the one thing that really concerns me that I found in a whole bunch of these reports is the data that's suggesting that people are no longer shopping their mortgages at renewal. And the federal government has now made it clear that banks don't have to worry about stress testing you when they go to move a mortgage from one lender to another. That makes it easier for you to be able to shop around. It makes lending more competitive. And I can tell you right now, the mortgage that people got 5 years ago, for 90% of people, probably is not the mortgage that is best suited for them right now, especially when you consider that rates are on their way down and you want to be positioned to be able to get the best rate when those rates do come down, even if it's midterm, which means you need to minimize your payout penalty risk, which means you don't want to get a mortgage from a B lender, a bank. You want to get it from a lender that has a better product because they have to have a better product. And more often than not, that means not backloading their mortgages with massive penalties. And that's the primary advantage when it comes to dealing with lenders like First National, MCAP, and any other number of non-bank lenders. Oh, and if you want to see more about the interest rates that those non-bank lenders are offering, make sure you check out this video right here.